I'm Keith McCullough, and welcome back. We go into the third conversation today, where it's my pleasure to have the Mr. McAlvany actually in the flesh. Good to meet you in person.
Hey, great to be here.
Yeah.
Thanks for having us.
The partnership that we have, which we'll talk a little bit about later on, is new. For a lot of people, buying precious metals, physical, is very new. That's my goal here, is to get them through the process. Like, why would you do that? How would you do that? What are the risks in doing that, and why do you do it differently? Like, if we can cover that, I'll be pretty happy about it. I think most other people will too. But first, I want to just talk about your background, like the history. Like, you live in Durango. We just talked about you. He's got 4 kids. We have that in common. I'd prefer to live in Durango, but I'm not allowed. Give us a sense of the history of the company and why you're doing what you do.
But my dad's original interest in gold, so it's a multi-generational family business. His original interest in gold was limited to the options he had open to him at the time. He was the national wholesaler for Van Eck.
Oh, really?
And the first gold share mutual fund in the country. And so that's late 60s, early 70s. Gold was illegal from 1933 for individuals to own. If you were a dentist, you could have it for putting in a crown or whatever. But unless it was sort of rare coins or jewelry, like, you couldn't own it. So his interest was in gold shares because that was a decent proxy. And you came through the guns and butter policies of the Johnson administration. There was a concern that inflation would be an issue, and the dollar was under more and more pressure in that time frame. So how do you hedge a portfolio? And gold is traditionally seen as sort of an insurance policy. I don't know that mining shares are a perfect hedge, because they can be certainly subject to market pressures. But that was the best he had.
Well, Van Eck, because Van Eck has the GDX, don't they? They have the GDXJ. They have those were mutual funds back then.
Correct, and they still have international investors, which is their gold share fund. That goes way back.
Way back. Okay.
Yep, and so they've iterated. ETFs are there, and that's an easy proxy for kind of a basket of companies. So he was meeting with a client one day, and this was a Hungarian refugee, and he pulls out a gold coin and he says, "This is what I'm putting my real money into." And my dad's looking at this. How do you do this? So he said, "Well, there's an exemption for religious relics, and I found a guy in Texas, of all places, and these are 1 and 2 ounce 24-karat gold medallions, and they've got religious themes on it. Jesus feeding the 5,000, Noah's Ark, various things like that, and they fit the exemption." And my dad's like, "This is brilliant." Took it and run with it. It was not an original idea, but this tax exemption allowed us to be in the bullion business in '72, and then he started working with Jesse Helms and got the legislation changed. January 1st, 1975, Americans could own gold again.
Your dad helped him change the legislation?
Yep.
Wow.
Yeah.
Was there a lobby?
There was a group of 3 guys, and he was one of them.
Really?
Yeah.
So you guys are like the OG family. You're like the Yellowstone.
It was pretty. We've tried to innovate and be forward thinking in the space.
Yeah.
But at the end of the day, gold's really basic. I mean, it's been treated like money for 5,000 years, and it's still how I see it. It's just a great denomination for a liquid position, a cash position.
Yeah. How did you, just because it's your dad doesn't mean that it would become your passion or that you wanted to do it. I mean, why did you do this?
Yeah, well, he said study finance and business, and I said I'm more interested in philosophy. Not a great place to go for future job prospects.
But the philosophy of the religious coin.
Yeah, I think there's ideas we look at the things that drive gold, and you can look at public policy, you can look at international relations, you can look at a broader macro context, and there are ideas that determine the course for a country, and certainly there's a philosophical base to it. We look at gold as something that enables agency. If you wanted to strip it down to something very philosophical, this is something that is real wealth, portable, private, and enables agency. In a down market, that's typically how it behaves. You have options that other people don't. Cash certainly gives you that. Just the question of how that cash is being managed. Now it's subject to, 600 PhDs at the at the Fed.
Lucky us. But at what point did the lights start to come on? Like because it's one thing to be, like you said, you have a 19-year-old son.
Yeah.
Yeah.
So I one of my first jobs was at an economic think tank in Santiago, Chile, and I started realizing like business is really quite interesting. Maybe my dad wasn't so off. After all, I think this happens. The older you get, the smarter your parents become. But there is a phase where they just don't know anything.
Yeah.
And so I transitioned to working at Morgan Stanley. Did that through the debacle of 2000, 2001, and 2.
Oh, really? So you lived through that?
Yep. And by the end of 2002, I realized that the program that Morgan Stanley had was, here's our products, we do the thinking, you do the selling.
Mm-hmm.
Just push the products. And it didn't sit well, partially because I'd grown up in a family business where like opinions mattered and dialogue was important, and we had it around the dinner table every night. And my opinion did not matter. Like their goal of sort of maximizing profits and minimizing lawsuits meant that they've got a team of people that put all this together and then just say, go
push paper.
Yes.
Yeah.
And it wasn't working well for me. So I talked to my dad in the winter of 2002, and I said, what would it look like for me to come back and work for the family business? His jaw dropped because it just wasn't something we'd ever talked about.
Really?
Yeah. I mean, and he said baseball, I said hockey. He said basketball, I said soccer, lacrosse. I mean, I was constantly going a different direction, and philosophy was an expression of that. So this was the first time that I showed any interest at all. And
wow.
It actually came about because there was an internal memo that Barton Biggs wrote, and he was one of the economists at Morgan Stanley at the time. There was Stephen, I think they had 5 of them.
Yeah, I mean, he was the highest profile, one of the top 3 guys to read on Wall Street.
And this was internal.
Yeah.
And he starts by saying, there's this crazy guy, he's got the pedigree, went to the right schools, but he's crazy, categorically. He was on the derivatives desk in the 80s and trying to convince us as a young guy that we should be, shorting the market. And we told him he was crazy. But he did it with his own money, and he's retired in Sun Valley. And he started this institutional-only gold fund, and he's crazy. But implicit to this whole memo was, unless we are, right? And it gave me the latitude to say, something's different here. The early 2000s, gold's making a turn from $300 an ounce. It's been irrelevant for 2 decades. Nobody's looking at it. And to get a plug from Barton Biggs and say, you should be thinking about gold, unless he's crazy. I made the call.
That's awesome. I mean, I remember that vividly. I mean, you and I have a very similar, we must be right around the same age because our kids are the same age. You're less gray than me, but it's because you live in Durango.
It's catching up. It's catching up.
And it's because you have more gold than me. He's happier. But I was the same thing. I went to the Old Wall, 1999. Went to Credit Suisse. It was called Credit Suisse First Boston.
Yep.
I sat on that desk for 9 months, and I had the same, just like, there's something about this that I don't like doing. I want to be buying and selling things for real. So then I went to the hedge fund side in 2000 as an analyst. 2002, 2003, I remember being like the youngest person by a lot. And I think I was primarily doing it to get like a free ticket back to the homeland, you'd know what this is, the PDAC. You know what that is?
Yeah.
The Prospectors Development Association Conference in Toronto.
Yeah.
And I'd walk in there, and it was like me and my grandpa. Everyone's smoking, hacking darts, talking about whatever junior mining company they want you to buy warrants in, this, that, and the other. I was like, wow, like this, like it's kind of like Ted Lasso. This smells like opportunity, right? Like the smoke.
Yeah.
Just that's when I got into it, and I got into it if only because nobody else was into it. So I came back to New York, which is where I flew back and all that, and that's when I first started buying gold. And then gold by 2011. Hit at that time its all-time high. The dynamics now are very different on what's making gold hit. Some of the main attributes are the same. Dollar down, rates down, money printing coming. Like we get that.
Yeah.
But let's talk about that then
Yeah.
which was your first bull run in gold, right?
Yeah.
From when you started to 2011 was an epic run.
Yeah, and it's
to
not
the one that we're in now.
It's not uncommon with any bull market, regardless of the asset class, to move in phases. And if there's sort of a maverick perspective, if there's a first mover advantage to someone kind of thinking differently, seeing an opportunity, if this, and this lines up, maybe this is going to happen. I'd say that was your 2000 to 2011 run.
Yeah.
I think the second phase has been largely Wall Street, where if you look at the product proliferation, Wall Street's kind of laid out the net. And third phase is when the general public participates, and we haven't seen that, not in the metals. We, in fact, last year, if you look at the share count of GDX, down significantly. It's actually contracting in terms of investor interest. Looking at ETF flows for GLD and SLV, also significant outflows last year. So how do you have, rising prices and falling interest? It's central banks. Central banks have been very keen to manage their reserves in a different way. And the change started in 2009 when they became net buyers for the first time. They had been sellers for a couple of decades, and became net buyers in 2009, marched their way up to about 500 tons a year, and now they're running at about 1,000-ton clip per year.
Gold you're talking about? Yep.
Yeah, and mine production's roughly 3,500 tons, so they're a third of the market today, whereas they didn't even have a footprint in the market if you go back in time. So we're $3,000 an ounce, and the general public has hardly noticed. And I there's certainly gold bugs who've noticed and participated, but the broad asset allocators, it's a non-starter. There's no interest. I sit on a couple of different boards, and to make a case for gold, it's like, oh, I'm still wearing a tinfoil hat. There's no interest. It's like, why would you own that when you can own Nvidia? Why would you own that when you can own Tesla or the Mag 7? And so I think it's been marginalized in part because other things have been working.
Yep.
I think we're at an inflection point in the market where other things are not working. There's a variety of reasons for that. What do you do as an alternative? For growth, or just to hedge and to look at something that is sort of an opt-out? Treasuries are typically a go-to. We've seen that move, and even in recent days, kind of a backup of that move. Rates start rising, it tells you something's, we've got volatility in the stock market, and yet yields are increasing.
And gold's going roof. I mean, it's like, today is not a day we've seen frequently.
No.
It's certainly not a trend. I mean, the trades, yes, you can have, but a trend, if gold were to go up 15 to 20% from here, and the 10-year bond yield, go up another 50 basis points, that would be squirrel to most people on Wall Street. And that's not our view. But it's interesting. Like when you look at it now, like what you said is. Tell me if you agree with this or not. What you said is a uniquely American experience with assets. Like the dude who's telling you I'm long Nvidia.
Yeah.
Whereas if you go to any of the, just pick one of the 40 to 60 dysfunctional fiat currencies in Latin America or Africa, and you go down the road to somebody and you have gold coins in your hand, and you say, would you prefer one of these or a certificate to own Nvidia? They're going to take the gold.
I'll take the gold.
Right. They're not going to, some of them actually would take, because now it could be on their phone, they could take digital assets. That makes some sense. Can you talk about that, like how the rest of the world, has gone with the fiat has failed, I love gold more than I ever have, versus this uniquely American experience of what is basically apathy?
Yeah, I think in many parts of the world it's just an assumed allocation. 5 to 10% of net worth, it's an anchor. If you saw it as sort of the keel of the ship, it brings stability and it enables greater power. Certainly if you're using it in sort of a rebalancing manner, you've got years where equities outperform, gold underperforms. There's an opportunity to slide one direction. Then when equities underperform and gold's outperforming, an annual rebalance puts you in a position to lower your cost basis. And so I think it's seen as like the stabilizer in a portfolio managed over time.
Yep.
And it's assumed, whereas here it's the exception. Like very few people see the value of it. That changed a lot during the global financial crisis, where hedge funds for the first time are asking questions about counterparty risk and saying, well, my money's theoretically across the street, but I don't know that I have it, and I don't know what's actually happening to it. And so when counterparty risk comes into play, certainly hedge funds will see it as a viable asset. And I think to some degree they're seeing it as a growth opportunity. So, look at the top holdings of major hedge funds. They've got a sprinkling of a Newmont, of an Anglo Ashanti. They're playing it for growth, not necessarily asset preservation or insurance. And so there's a difference in motivation and maybe different avenues that you would go depending on what you want. Mm-hmm. If you're looking for growth, there's a way to play that. Mm-hmm. If you're looking for asset preservation, it's a totally different deal. So on that basis, even looking at the difference between gold and silver offers some growth dynamics that gold doesn't. Irrelevant for central banks. It's one of the reasons why central banks don't allocate to silver. They're looking at it as a reserve diversifier and a stable part of their portfolio, also something that gives them control where the Treasury Department can't come in and scoop it up. Mm-hmm. 2022, that's what happened with the Russians. $300 billion of their money Treasury just took. And that actually, I think, is one of the big drivers of central bank demand, saying, wait a minute, between the State Department and the Treasury, maybe the stuff that we have on account, it's ours in theory, but in practice, possession's 9/10 of the law. And maybe we want a little bit more control of our destiny. Mm-hmm. Maybe we don't want as much leverage to be put on us, given different policy priorities, in the realm of international relations. So they're wanting insulation. That's driving demand. It's just different than a growth play, where silver comes into the conversation, platinum comes into the conversation, the miners come into the conversation, depending on whether you want the tangible assets or paper play.
It's interesting, like because I deal with institutional investors every day, not all day, but we're having this conversation, but I could easily be on with an institutional account. Like, well, what part of the market do you like? And they're generally talking about stocks, right? And then once you get to GDX, which has been phenomenal as of late, they're like, I hear you, next, on to the next. So it's like, and there's a heck of a lot of volatility in GDX relative to a lot of sector exposures. There are a lot of reasons for that, but there's also very little market cap, relatively speaking. So it wouldn't change their performance, so to speak, by making even an outsized bet. Yeah. Whereas what I'm starting to see, and it's infrequent, but it's happening, by people who have more money than the other people. It's kind of an interesting thing. One of the richest families in the Northeast, their family office texts me, like almost the guy that runs the CIO for the family, he's constantly texting me about what Besant means, and the U.S. monetizing their balance sheet, and how much gold the U.S. government has, and what that means, and how they should be positioned in physical, how much physical they should buy. I'm like, right. First of all, if you want to talk about physical, call McAlvany. but those conversations I've been running this place for 17 years, and nobody's ever called me or texted me about these things. Those are starting to happen. Another billionaire in Palm Beach, same thing. It's his focus. He's like, how do I get the physical? How do I get the physical? These are sophisticated institutional investors as well, but they come at it differently because their job isn't to just be dogmatically anchored on U.S. stocks. So right. Are you seeing that? Do you guys, or am I on the front end of that?
Well, particularly since the beginning of the year, we've seen the exchange for physical. That's happened a lot, where folks are taking delivery of their contract exposure, and that's happening on a large scale. Where people are taking delivery of 1,000 ounces of gold, 5,000 ounces of gold, 10,000 ounces of gold, and
people being not
people.
like so families,
yes. family offices, high net worth. That and I think they're sensitive to the changes that are happening being structural and systemic in nature, and they're not sure what it means for a variety of asset classes, or even for the world as we've known it post World War II. Things are changing.
Yep.
And that could be for the better, that could be for the worse. The fact that we don't know just registers as uncertainty, and uncertainty drives interest in something like gold. Mm-hmm.
What's interesting too is that they're funding these purchases with sales of NVIDIA. To them, it's just asset allocation.
Yeah.
They're constant, like anybody who's built wealth has diversification, I think. I mean, unless you want to be a billionaire who becomes a millionaire the wrong way. I mean, they get it, and they understand not to just stay one way. So it's maybe ironic that they're funding their these increasing in terms of size, like these types of purchases. I guess the one thing that they probably really do a lot of work on with you guys is the delivery. How safe is it? The insurance. I think I walked through this with Tori. I mean, it's like Tori works at McAlvany. That kind of a discussion, is that like 100% of the time? If somebody comes to you and says, "Look, I'm interested in buying physical gold," like how does the process work? Delivery.
Yeah, a lot
insurance.
of clients will take physical delivery of their metals.
A lot, like most, or
60%, 70%.
because can you explain? You have the two options where you can take delivery, or
Yeah, you can either have it delivered or you can have it stored, and that would be at a COMEX NYMEX depository.
Yep.
Anything other than a COMEX NYMEX depository, I think is a bad idea.
Would anybody quibble with that? Would anybody say, "Nah, he's full of shit. Those things are risky. You could lose it. You could wake up one day and it's gone."
No, because you're dealing with bailment agreements where what you have stored, it's yours only. It's an allocated position. If you want to pay more, you can actually have it segregated. Of course, when it's segregated, you're actually paying for a lot more space that you're not using.
Yep.
But you can have it either in allocated form or segregated form stored, and it's deliverable at any point. That nothing can be done with that product. It can't be leased out. It can't be put under any sort of a. It's yours.
It's the opposite of a bank.
It's not there. Your money is there. No, it's not there.
But why did you define it properly with like COMEX? What did you say it is?
COMEX or NYMEX?
COMEX or NYMEX. What's the difference between that and somebody who says, "Look, I'm at bullion.com or whatever, and we store it," and you're like, "Okay," because there's a lot of fraud.
Yeah, in 50 years of business, there's been enough cases where it's not all there.
There have been plenty of cases, right?
Yeah. And so you want a group that spends half their time going through audits and certifications of product count and everything. So that is your COMEX NYMEX depositories. These are groups that will store with. They'll store for the DEA if there's a confiscation of assets. They'll store for all your major Wall Street firms,
yep.
and everything has to. I's are dotted and T's are crossed.
Mm-hmm.
So if you're going to have it stored, that makes sense. Like we have a program called Vaulted, and it's one of our many iterations. It's kind of a fintech solution for owning larger format bars, kilo bars, the Royal Canadian Mint, 1,000-ounce bars with HSBC London. We like HSBC, and we like the London market because it's the deepest, most liquid market.
Bars.
Yep. And so buying large format bars, liquidity is the very best in that space. So liquidity is best, cost is best, and again, these are entities that have either the Crown's imprimatur in Ottawa, or HSBC. It's one of their business lines.
So you said 60-40 roughly that people would be buying, taking delivery versus putting it in a vault?
Yeah, and a lot of folks will use IRA assets. Individual investors will allocate to physical metals, and they can't take delivery of it. So that also would be at a NYMEX COMEX depository, if you're using qualified money.
What's the biggest, if you're allowed to tell me, or if you want to tell me, you don't have to obviously, but what's the biggest physical shipment you guys have ever made?
Where someone has actually taken delivery?
Yeah.
17,000 ounces of gold.
I'm just laughing because...
And they didn't want it stored. They wanted
at
their
their
house.
Yeah, so I'm laughing.
I don't think that's a good idea.
I was this guy at my golf club in 2011. Okay, bad year to market. But now he's like, yeah, man, I finally agree with you on your gold thesis. I'm like, dude, it's not a thesis. it's an asset allocation. I always say this all the time, but he's like, no, I'm going to buy some, and I'm going to get it delivered to my house. And I'm like, okay. He comes back like the weekend after, whenever I saw him next. He's like, man. He's like, you didn't tell me. He's like, my wife came out. They had to get dollies, and I'm like, how much did you buy? And he's like, well, and he told me X millions of dollars worth of gold. I'm like, no shit, Sherlock, it's heavy.
Right.
And he's just like, oh, I got, then it was outside and I couldn't get home.
Well, try silver. The current ratio is 100 to 1. So in terms of the monetary value to space, it's going to take up 100 times the space, which is where COMEX NYMEX depository makes all the sense in the world.
We have another client who has that problem. He bought so much silver that it was the concrete in his garage sunk.
Yeah.
So he couldn't. Anyway, the problems with physical, I'm laughing about it just because in my own mind it's just funny. But the problems are manifest. I mean, these are like real world problems. Like Laura McCullough doesn't want to take delivery of 25 bags of junk silver.
Right. No, and you also kind of take yourself out of an easy opportunity to compound your ounces. Bags of junk silver haven't been made since 1964. These are your dimes, quarters, 50-cent pieces. $1,000 face value bag is either 10,000 dimes, 4,000 quarters, or 2,000 half dollars.
Yeah.
715 ounces per bag. They haven't made them for a long time, so there's periods where demand drives premiums on the bags, and we'll see the premiums at, this is on the bid side, 10%, 15%, 25% over just the raw silver content. Mm-hmm. If it's sitting at a COMEX NYMEX depository, when there's premiums on the bags, we'll sell the bags and buy 1,000-ounce bars, wait for the premiums to come back down.
Yep.
Now you've just captured the premium in free ounces, and you're waiting to reposition in bags again. That's something that happens instantly if it's at the depository. It's a pain. You're either a Brinks truck or you're spending 2 days schlepping bags down to the post office.
Yeah,
it's impractical.
Oh, it's. I mean, I did this video where, I had one bag I got from you guys of junk silver where I showed it's on my Instagram. You can see it actually. It's Mucker11 my Instagram, but I basically pour the bag out on my deck with my dog out there just to show people the girth of how much
Yeah.
There's I don't know, bag's probably worth 22 grand worth of silver, junk silver. The amount of feedback I got on that, first of all, from my kids. My kids are like, wow, what is this? And it's like, these are card kids, right? They don't even have, they wouldn't even know what it means to have this in your back pocket.
Right.
Because their mom gives them a credit card or it's in their phone.
Yeah.
They were amazed by this. And so are a lot of people. And I wonder if that's what when you said, look, Americans aren't really bullish on gold, they're not bullish on physical. Do they need to come to some realization, some physical, there needs to be some physical interaction with it, they need to see it respected? I don't know.
I think there is a difference in generations. Sort of under the age of 40, there's the question of why would you bother me with physical delivery? That just seems like an encumbrance, and please don't send it to me. So having it stored, using our vaulted program, something like that makes a lot of sense. I think over the age of 40, it's more of, if I don't have it in hand, I don't have it.
Really?
And so I think when you come back to that 60-40, some of it is age driven and some of it is scale.
But do you think that there's any, how would you envision, if you could, our kids being infatuated with physical, precious metals in their hands?
I've created the infatuation.
Really?
Oh yeah. I've got 4 kids, and each of them have a cigar box, and the cigar box is gradually filling with ounces. They've got odd jobs and sources of income that they can invest, and I've basically said, whatever you put into physical metals, I'll match. And my oldest is not. He doesn't run numbers. My second boy runs numbers, and he's like, so I'm up 100% day one. He loves it, and he does it all the time.
That's a 401k match.
He needs a larger silver box.
Yeah.
You know,
Oh, really?
bigger cigar box. But it's fun to see them like interact with it, and so it's become a part of our family culture.
That's that's an interesting one, because I mean, there's always a chance, right? And at some point, well, I could just tell you that Jack McCullough's crypto account doesn't have a lot left in it, right? Because he's like most people who don't listen to me; they just bag hold things. So he doesn't ask me about it anymore. So you got to lose money or lose wealth or whatever, however you want to define it. I wouldn't call crypto money. I would call it gold money. I know you probably have some thoughts on that, but I also wanted to make sure I asked you about this, this 90-day tariff and its impact on the whole thing. Like, what's the deal here?
Well, the concern has been that there would be a restriction on imports or a tax on the importation of gold. So we've seen a ton of metals move really from November to the present from the London market and Switzerland to the U.S.
Unprecedented. I mean,
Yep.
the time series charts that we show in our macro presentation, I'm like, is that right?
I mean, so much so that it's impacted GDP figures.
Right.
You know, if you're looking at GDP growth, part of the reason why we're negative is because of the mass gold imports. Yep. And so instead of a, current GDP now figure, I think is negative, let's call it 3. It ends up being more like 1.2%
Yep.
negative when you factor out gold imports. It's been on a massive scale.
Mm-hmm.
It has not been, to date, it has not been an issue. And certainly with Canada, we've got the U.S. Canada-Mexico agreement, which is not, we don't review it again until the middle of 2026. Mm. So it's exempted.
USMC?
Canada and Mexico.
Yep. Yeah. Okay.
So, part of it has been what happens if people want to take physical delivery and the COMEX shelves get wiped out and there's not enough. Let's make sure we have enough and we're not paying,
huge tariffs. Yeah.
Yeah. So it's hasn't been an issue to date. I don't think it'll be an issue, partly because, this is something that central banks collect, and moving that around would be an issue.
But even with, right before we sat down, you mentioned this, even with Canada, which is certainly a fear given the newsiness of it all, you don't have to pay tariffs on maple leafs or anything like that.
Not to date. And, like the program that we have in Canada wouldn't be affected anyways. What we do when someone wants to take physical delivery from their vaulted account, we deallocate from the account. It can either be shipped directly from Canada or it can be delivered in any form. So if somebody wanted to take delivery of kilo bars, they could take delivery of US kilo bars, and we would just be liquidating Canada and shipping from a US inventory. So it wouldn't have an impact.
Now, when you say your programs, does that mean, like, do you commit, and did you pre-buy, did you front run this whole thing? Do you take on the risk, the inventory, or do you just, it's built to order?
We carry enough inventory for there to be smooth transactions. So but it's in the millions that we keep in inventory for sort of daily draws, and that can be replenished.
Yeah.
Minute by minute.
Is that how you blow up? Is making bets on inventory?
Absolutely, and that's one. So
absolutely.
Yeah, I mean,
Okay.
that's one of the reasons why these storage facilities that are not COMEX and NYMEX. We had one in Delaware blow up last year, and it blew up because they were making a directional bet on the metals and assumed that they would get it at a cheaper price, and they didn't. It moved against them, and now all of a sudden they don't have enough product. And this I think is kind of how, I don't know for sure, but my guess is this is how Bernie Madoff got in trouble. I don't think he started as a bad actor, but you make a couple of bad bets and then you don't own it. You recognize the loss, and now all of a sudden you're trying to play catch up, and you're taking bigger bets, and that can compound negatively against you. It's bad portfolio management, and it's certainly outside of the realm of fiduciary responsibility too.
Right, so that's how the dealer blows up. how the individual blows up, I want to make sure I touched on that. We don't have a ton of time left, but the experience that, and this has to do with it has to explain partly why Americans are not, bubblicious about gold or about precious metals, because they've been ripped off. Like a lot of people have been ripped off.
Yeah, I mean the industry, that's certainly the case. It's not a clean industry, and so there's that risk. I think the bigger reason why there's not more allocation to gold is because Wall Street's been very effective in basically saying we don't think it's necessary.
Yeah, because that's the big money. Yeah.
It's a commodity, and who needs a super volatile commodity exposure in their portfolio?
Right.
When actually they've misdefined it to start with. It is money.
And it's actually one of the lowest volatility assets you could have ever owned historically, so that's bullshit. I mean,
right.
So even
negatively correlated to stocks, which actually helps you. So if you wanted a pure growth portfolio, we ran these numbers in the late 60s, early 70s, reran them maybe 3 or 4 years ago. Optimal exposure would be 75-25 for just a growth-oriented portfolio with that annual rebalance.
Yep.
And that's going to outperform 100% exposure to stocks, because in your years where you've got a drawdown, you're able to take your gains from gold and reposition. Mm-hmm. So your return to full value is just as an asset allocation, using it as a way to buffer downside. It's magic.
Yeah, I've never. I mean, compounding tends to be right. I mean, it's one of the wonders of the world. I think Buffett called it. But I've never met somebody who is wealthy, in particular, built their own wealth, runs their own business, built their own wealth, and runs their own money. All that doesn't understand it. Rare. And if they don't understand it, and I'm trying to explain it in my simpleton terms, they'll get it, and they'll probably buy it. Yeah, I've convinced plenty of people to own gold over many, many years. And so we're not going to fix the institutional problem that is Wall Street. I mean, that's not going to get fixed. But what I meant was, how do we fix in the minds of
there's another aspect to Wall Street not liking it, which is that it's a removal of assets under management.
Right.
If somebody takes the money out, that 1%, magic 1% per year for managing assets, it's on a diminished base.
Well, that's instead of magic, I call that art. The art of running money is having money to manage. I mean, so. But back on, so how do you get people comfortable with being uncomfortable? Like my grandma got this, she's watching this commercial, buy gold.
Yeah.
And all of a sudden, the money's gone. There's so many scams on the internet, on TV. It hasn't been largely regulated.
It's not regulated at all. So it's very much a buyer beware market. And so
I like it for that reason, but most people are not going to
Yeah, I mean, there's a freedom that's nice. It does mean that you've got to be able to run math and figure out if you're paying 2%, 4%, or 40% in terms of commissions. And we've got plenty of competitors out there who will charge 10, 20, 30, 40% commissions, or more. It's crazy. And people just aren't. They don't know. Somebody says, "Hey, this is really special. You should own it. It's limited in quantity. So it's a little bit more." What they've started to do is do different size coins. So the math is almost impossible to do fast. So 1 1/4 ounce, 1 3/4 ounce. So you're buying a 1 ounce silver round, but it's actually closer to 2 ounces, and that's why we're charging you $150.
So it's the same as the central bank clipping coins 300 years ago, but it's just doing it against people who don't do math.
Yep.
Man, that's terrible. But that's an opportunity for a lot of people.
I think just doing your homework, being informed, and we've been in business for 53 years. We don't advertise on Fox Business. We don't advertise. This is not we're not on with Glenn Beck. The guys that are paying Glenn Beck $1 million a quarter, that money is coming out of their client's hide, right? And we prefer to grow through referrals, through strategic relationships, and that's good enough for us.
That's how we're partnered. I mean, that's why I wanted to do it, because it just makes good business sense. When you're tied to the ad dollars, oh shit! You're like Hedgeye, less than 1% of our revenues is advertising. It's not even a thing. But to say, hey, whether it was Eric Larkin initially or Tori, okay, I'm interested in buying this, silver, gold, platinum, etc. And to get transparency, I know what this price is on my screen, and to get a transparent feedback loop that's real time, and say, okay, and this is going to be the upchart, this is going to be the commission, this is going to be where it is relative to its prior premiums. It's just like any other thing that I'd transact in. Like, to me, I wouldn't call that old school. I just call it transparent, accountable, and trustworthy is what I want.
Right. I think add to the transaction transparency, we bring something different to the marketplace, which is strategy. And if you're trading like the bags to bars ratio, that premium is great. Gold, silver. We're currently in the overnight market. We hit 26.75 on silver. That was Saturday, or Sunday rather, and that's 107-to-1 ratio. We don't see. I mean, I can count on one hand the number of times we've been over 100 in 100 years. And so, you could either look at that as a trade, and you're bearish silver now on your categorization. But if you look at it from the standpoint of the trail, this is something that you have to look at from a long-term perspective, because you don't hold the 100 level. That ratio will shift to 70, 60. Yeah. The most recent big trade was to 40-to-1. During the global financial crisis, we had the peak in gold and silver 2 years after, and we got to a 31-to-1 ratio. So you're talking about double or triple in terms of performance relative to gold. Well, that's a different conversation, growth versus just asset preservation. Yeah,
that's I mean, to go back to Northeast Family, very specific conversation on this. They're like, okay, well, the reason why we're getting, and they actually speak in ratios, the reason why we're getting that ratio is because there's a liquidation. There's a liquidation across all things, hedge funds. Many more hedge funds certainly trade silver futures. I mean, there's a lot of pin action in silver, both the SLV, which I trade options on too, but I mean, it's, you have that, but then they'll say, I have my long-term view. Your long-term tail view, Keith, is 3 years or less. Mine is 30 years, and that's where they were telling me what silver is going to be worth if they're buying physical down here, and just using the ratio,
right?
Which would blow the mind of people. People don't even believe it.
Well, one of the most powerful ratios for folks who are managing money intergenerationally is the Dow Gold ratio. Yep. And it pegged 18-to-1 in 1929, went to 1-to-1. It pegged
18-to-1.
18-to-1 at the market peak.
Wow.
28-to-1. You see that the influence of sort of the unmooring of money,
right,
and the upside in shares versus ounces. So it was 18-to-1. We moved to 28-to-1 by 1968, and we went into a bear market in 1968 through, I guess 1982 is where you could call the market pivot, and we were back to a 1-to-1 ratio, gold to the Dow. Went to 43-to-1. We got as low as 6-to-1 on the Dow Gold ratio in 2009. So March of 2009, it was 6-to-1. Marched back to 22. So in real money terms, the Dow never got to new highs. In nominal terms, 44,000 is great. Yep. But in real terms, it only retraced half of. I mean, it's an interesting way of seeing the markets. And again, managing money on an intergenerational basis. Now you're taking some emotion out and saying there's times where you should be long gold for a long period of time, and there's times when you should lighten up. And I would suggest, today we're at 12-to-1 on the ratio. You've got a good stretch to 5-to-1, 4-to-1. You typically will see 3-to-1 based on sort of economic, fiscal dynamics. Yep. 1-to-1 if you layer in something sort of geostrategic. And that's where you had 747s loaded with gold leaving Riyadh on their way to Switzerland when we were at a 1-to-1 ratio. 3-to-1 was the best you're going to get on an economic basis. Then you have the Russians invading Afghanistan and the idea that the oil fields are going to be shut down, and there's a mass panic into gold, and boom, that geostrategic event drives it to a 1-to-1. I'm not sure we'll see 1-to-1, but 6, 5, 4, 3, I think we'll see those numbers. And so you're looking at a multiplication of purchasing power. You could move to cash and you'd have additional purchasing power. Having gold as a part of your liquid position gives you leveraged purchasing power. And so from 12 to 3, that's a decent bump if you want to migrate towards shares at some point.
Mm-hmm. Well, that's a good spot, well, because we have to end the conversation, unfortunately. But that's good, really good for your son with the cigar box, especially the younger one who does the math. And you just gave a 3 minutes or less pitch on why you will never work at Morgan Stanley. So you don't have to worry about that. The wealth management business there is far too large for you to be talking such things. So thanks for educating our community, because we actually have a fair amount of Morgan Stanley advisors who pay us, who don't go with the old wall ways. They completely understand the value of where gold is in terms of real purchasing power and where it fits as real money. So thanks for
Great to be here.
Yeah, providing the education. That's awesome.
We're excited to be working with you, and it's important. I think some of those ratios, the Dow Gold ratio in particular, is helpful for knowing when gold is too expensive.
Yeah.
If somebody says 3,000 is just too much to pay, the ratio would suggest otherwise. And we could have a conversation about technical analysis and the consolidation that it's been through over the last 10 years and price projections and all of that. I don't even care where the price goes. It could go higher or lower. My purchasing power at 3 to 1 is pretty compelling. And that could be with gold at 3,000, and I don't even want to think about where the Dow is at that point. Or it could be with gold at 5, 6, 7,000 and a modest 50% correction in the Dow.
Great lesson for your kids. Purchasing power, imagine that. Thanks, appreciate it.
Thank you.
Yeah, he is Mr. McAlvany, and you can get, we do have a partnership, so we have, like me, I get a discount whenever I buy physical from them. You guys can get the same discount. I think we have a code somewhere on that, but you can definitely reach out, and we certainly appreciate your audience for day 2. I'll see you tomorrow.